Welcome to today's video where we dig into a bold claim. Financially disciplined consumers should consider ditching their debit cards and shifting everyday spending to credit cards, while paying the full balance every month. We will explore why this approach can maximize security and rewards, and we'll also discuss the essential caveat: self-control. As we move through this video, we'll cover how fraud liability really works, how rewards add up, the mechanics of using a credit card safely, and who should avoid this strategy. Let's begin.
Here's our roadmap. First, we'll compare debit and credit from a security perspective. Next, we'll quantify rewards and cash back. Then, we'll dive into the crucial caveat: self-control. After that, we'll walk through a practical, step-by-step system for using credit cards safely. We'll also use diagrams and a flowchart to help you decide if switching makes sense. Finally, we'll test your knowledge with quick quizzes and wrap up with key takeaways. Let's transition to an important disclaimer before we go deeper.
Before we proceed, please note, this content is educational and not personalized financial advice. Everyone's financial situation and risk tolerance are different. Interest rates, fees, and bank policies vary by issuer and country. Always read your card agreement, understand your billing cycle, and consult a qualified professional if you need advice tailored to your circumstances. With that said, let's move into the core argument. The central claim is straightforward. Move daily spending from debit to credit to gain stronger fraud protections and earn rewards, provided you pay your full statement balance each month. Debit transactions offer essentially no return and expose your checking account to direct withdrawals if fraud occurs. Credit transactions, however, usually shift liability to the bank and can be reversed without freezing your own funds. On top of that, credit cards offer rewards, cashback, or points, often ranging from about 1.5% to 6% on common categories. A non-negotiable rule is discipline. Treat the credit card like a debit card and never carry a balance.
Now, let's transition into security and fraud to understand the stakes. From a security standpoint, credit and debit are not equal. With credit, fraudulent charges typically become the bank's problem first. The issuer investigates and reverses unauthorized charges, and your own cash remains untouched throughout. With debit, fraudsters pull money directly from your checking account, often triggering freezes and leaving you without access to funds while the bank investigates. This can be a major disruption for bills and essentials. Therefore, from a risk management perspective, using credit for everyday transactions can be significantly safer. Next, let's turn to rewards and see how the numbers can work in your favor.
Let's compare key dimensions. Debit pulls funds straight from your checking account, often provides limited purchase and fraud protections, typically offers no rewards, and can result in your money being frozen during fraud investigations. Credit, by contrast, fronts the bank's money, offers stronger dispute mechanisms, provides rewards on everyday purchases, and keeps your checking cash accessible. The trade-off is behavioral. You must exercise discipline to avoid carrying a balance or incurring interest. Now, we'll quantify the impact of rewards to understand potential gains. This table shows representative ranges for common reward categories. Base purchases often earn around 1 to 2%. Groceries can range higher, sometimes 3 to 6%. Gas, transit, and dining often earn 3 to 5%. Rotating categories and targeted offers can be even higher, but may involve activation or caps.
Specific rates depend on your card and the issuer's terms.
Next, we will illustrate how these percentages translate into real dollars, using a simple example and a visual breakdown. Let's run an example. Suppose you spend $2,000 a month. If 30% goes to groceries at 3% cash back, that's $18. Dining at 20% with 3% earns $12. Gas and transit, also at 20% with 3%, adds another $12. The remaining 30% at 2% yields $12. And in total, that's approximately $54 per month, or about $648 per year, assuming you pay your statement in full every month and avoid interest. If you carry a balance and pay interest, those charges can quickly overwhelm the value of rewards. With the numbers in mind, let's transition to the behavior that makes or breaks this strategy. Here's the practical system. First, treat your credit card like a debit card and only spend money that is already in your account. Second, set up automatic full statement payment to avoid interest entirely. Third, know your billing cycle and due dates. Fourth, start with 1 or 2 cards that align with your top spending categories. Fifth, use the card lock feature in your banking app when you don't need to transact. Sixth, enable alerts and review transactions regularly to catch any anomalies early. Seventh, redeem rewards strategically, cash back for simplicity, or travel for potentially higher value. Eighth, review your spending and card lineup quarterly to ensure you're still maximizing rewards.
Now, to help you decide if you should switch, let's visualize a decision flow.
This flowchart asks a pivotal question. Can you commit to paying your statement in full every month? If yes, the next checkpoint is whether you have an emergency fund. If you do, you can switch most daily spending to credit to gain rewards and protections. If you don't, build a cash buffer first and consider starting with a single, simple card. If you cannot commit to paying in full, stick with debit to avoid interest and debt risk. Additionally, if you have a history of overspending, a secured card with a low limit and a strict budget may be safer. This visual is meant to reinforce that behavior and discipline drive the outcome.
Next, let's test your understanding with a quick quiz.
Quiz time. The question is, which method typically keeps your own cash most protected during fraud, debit, or credit? Your options are A, debit card, B, credit card, C, prepaid gift card, and D, cash withdrawals.
You may pause the video now to think about the answer.
B.
We will discuss the correct answer in the next section.
The correct answer is B, credit card. Because a credit card uses the bank's line of credit first, your checking account isn't directly debited in a fraud event, which usually means faster resolution and uninterrupted access to your own funds. Now, let's do one more quick question on behavior and discipline.
Second quiz question.
When should you avoid using credit cards for everyday spending? The options are A, when you reliably pay in full each month, B, when you track your budget and have an emergency fund, C, when you struggle with overspending or can't pay in full, and D, when your card offers 2% cash back. You may pause the video now to think about the answer. We will discuss the correct answer in the next section. The correct answer is C. If you struggle with overspending or cannot reliably pay your statement in full, credit cards can become costly due to interest and fees, and you should avoid using them for everyday spending. With that clarified, let's walk through the life cycle of responsible credit use to cement the process. This sequence diagram illustrates responsible credit use across a billing cycle. The user makes a purchase at a merchant. The merchant seeks authorization from the credit issuer, who approves if everything checks out. At month's end, the issuer generates a statement. The user pays the full balance automatically from their bank account. The issuer posts the payment, and the rewards balance updates, becoming available for redemption. If a fraudulent charge occurs, the issuer initiates a dispute and reverses the charge, while the user's bank account remains unaffected during the investigation. This flow reinforces why paying in full and automating payments are central to the strategy. Next, let's summarize the key points you should take away. Here are the key points. First, credit cards typically offer stronger protection during fraud events. Second, rewards can add up to real money if and only if you avoid interest by paying in full every month. Third, discipline is the critical factor that determines whether this strategy works for you. Fourth, start with 1 or 2 cards optimized for your spending categories. Fifth, automate full payments, monitor activity, and use alerts to quickly catch issues. With that in mind, let's wrap up. In summary, if you are disciplined and consistently pay your statement in full, shifting everyday spend to credit is often both safer and more rewarding than using debit. If you tend to overspend or carry balances, it's better to stick with debit to avoid interest and debt. Build an emergency fund and put full autopay in place before you transition.
Use the diagrams and checklists from this video as your roadmap.
Finally, let's close with a friendly request.
Thanks for watching. If you found this helpful, please like the video, share it with someone who could benefit, and subscribe for more content on smart money mechanics.
I'd love to hear your strategy in the comments. Do you prefer credit, debit, or a hybrid approach, and why? Your experiences can help others learn. See you next time.